Cost Accounting, Chapter 7. In Chapter 7, we're going to talk about cost allocation of departments. So what is the strategic role of cost allocation? Well, we want to determine accurate departmental and product costs and use those as a basis for evaluating our departments and the profitability of different projects. It motivates managers to exert a high level of effort to achieve the goals of top management. It helps us provide incentives for managers to make decisions that are consistent with our company. So we might have incentives such as if they meet those goals, they get pay rewards or bonuses. It's used fairly often to determine the rewards earned by managers for their effort and skill and for their effectiveness in managing their department or division. When we're looking at cost allocation bases, remember we're trying to find a cause and effect relationship. So the most clear and unbiased basis for cost allocation exists when we have that cause and effect relationship, such as the relationship between machine breakdowns and maintenance costs. Other alternatives exist in the absence of cause and effect relationships, such as the benefit received or the ability to bear the cost. We have ethical issues around cost allocation. So when we're allocating to products or services that are produced for a competitive market or a public or governmental entity, there's incentive to shift costs from the competitive products to cost plus base products, since cost plus pricing can increase revenue and profits. However, when we have this equity or fair share issue, if we have a governmental unit reimbursing the cost of a private institution, or when we provide a service to the public for a fee, the choice of our allocation method can be biased because it will affect revenue and profit. So when we're looking at this, we're thinking, how are we going to allocate all of our service department costs to individual products? And we might be incentivized to make those allocations higher to products that we can demand a higher price for because we get a greater return on them then. Rather than using a cause and effect or something that makes sense in the actual usage, we're just shifting costs to wherever it can be bared the most. So another ethical issue is the effect of the choose and allocation method on the cost of the products sold to or from foreign subsidiaries. So this is where we look at transfer costs between our two subsidiaries. So we can look at allocation methods that have the effect of increasing the cost of products purchased in high tax countries or in countries where the firm does not have favorable tax treatment. We can use these transfer costs to reduce our overall tax liability. So when we're looking at cost allocation, there are a lot of opportunities for unethical decisions to be made. We have three general approaches for overhead allocation. So we have the volume-based approach, where we allocate overhead from a single cost pool, Chapter 4. We have the departmental approach, where we allocate overhead to production departments and then from production departments to products. That is what we're going to look at in Chapter 7. And we have the activity-based approach, which allocates overhead to production activities and then from production activities to products, such as we looked at in Chapter 6 with activity-based costing. A production department is a unit of the manufacturing company that is involved directly in producing the company's product or service. So this is the manufacturing process. A service department is a unit of the organization that performs one or more support tasks for production departments. Service departments are things like IT services, the accounting department, the human resources department. They all perform support tasks for production, but they're not involved in the actual production of the product. When we're looking at applying these departmental costs into production and service departments, we have 3 phases for allocating those costs. First, we trace all direct costs and allocate indirect costs to the production departments and service departments. Second, we're going to allocate the service department costs to the production department. And then third, we're going to allocate the production department costs to products. So the first phase is to trace direct costs and indirect costs to all departments. So we have 2 service departments and 2 product departments. The second phase is to allocate those service department costs to the 2 production process departments. And then we allocate production department costs to products. So we're going to look at this company that has 2 products. They have 2 production departments, P1 and P2, and 2 service departments, S1 and S2. We use labor hours to allocate indirect labor costs and machine hours to allocate indirect labor costs. So we have information about our labor hours in all 4 departments, our total labor hours, our machine hours in all 4 departments, and our direct costs. For indirect labor, we have a total of $25,000 and our indirect materials are $5,000. Direct costs are unique to each department. So for our service department, when we're looking at the percentage of total direct labor hours used, the 2 service departments use 15% and 10%, and the 2 production departments use 30% and 45%. Then we also have our machine hour usage broken up by percentage. So in phase 1, we're going to allocate overhead costs to departments. So we have indirect labor, a total of $25,000, of which we're going to allocate based on the percentage of direct labor hours used by each of the 4 departments. Then we have indirect materials, a total of $5,000, which we allocate to each department based on their percentage of machine hours used. We now have total direct and indirect costs for each department. So our first service department has $5,850, second service department $8,250, first production department $24,750, and second production department $27,150. Now we move into our phase 2. In phase 2, we allocate those service department costs to the production departments. There are 3 methods used to allocate the service department costs: the direct method, the step method, and the reciprocal method. First, we're going to look at the direct method. So we're going to allocate our costs from the Service 1 department and the Service 2 department to the 2 production departments. So we look at what service percentage do we provide to those production departments. So Service Department 1 says that they provide an equal amount of service to both production departments. So they are going to allocate their expenses equally. So they allocate their costs based on a 50% cost. The Service 2 department says that they provide 30% services to Production 1, but Production Department 2 uses at a much higher usage, double the usage as Production Department 1. So they're going to allocate based on a 33.33% and a 66.67%. their costs. Therefore, now we have totals for the production unit of $30,425 and $35,575 under the direct method. We look at our two products. So we have labor hour usage and machine hour usage. So we allocate our costs to those products based on their machine hour and labor hour usage. So of production department 1's cost and production department 2's costs, 50% of the labor hours go to each department, and the machine hour costs are split 25% and 75%. So now we have our total cost for each product line. So we have gone from having overhead costs to 2 service departments and 2 product departments to allocating our service costs to the product departments, and finally to our 2 products using the direct method.